there are some global things happening that impact everybody. And right now, the big global activity that has everyone kind of anxious and nervous is all the military action that's happening in Iran.
Real estate is really an opportunity. Most people are just not familiar. Let's change that.
Access granted.
What's up, guys? My name's Gus.
And I'm Brad.
And this is the Commercial Department podcast. And in today's podcast, we're going to be talking about, of course, commercial real estate and all the things around commercial real estate. But today in particular, I want to address sort of the elephant in the room.
Yeah.
And, people, obviously, we want to, it'd be nice to be able to just operate as per normal. But there are some global things happening that impact everybody. And right now, the big global activity that has everyone kind of anxious and nervous is all the military action that's happening in Iran. And, we're not going to get into the politics of it, whether you agree or disagree with it. That's not part of our conversation today. But there are some impacts that could have on commercial real estate. And we kind of want to talk about what our thoughts are on where that impact could happen, where there may be some opportunities, and if you're just wanting to kind of stay conservative and you still want to do something where you could potentially move money around to still be in a good place. So that's kind of where we're at right now. I am not a fan of war in general. So, but I understand there is sometimes that has to happen in some cases. I'm not going to get into what my position is on it, but there are definitely going to be some negative impacts that are going to happen in the commercial real estate world, as well as I'm sure other industries.
Yeah.
So I'd like to kind of talk a little bit about what negative impacts are going to be happening in commercial real estate. Do you have any specific thoughts before I get started?
Definitely, I think, especially with us living in Orlando, going ahead and being a tourism hub, one of the first things that we're going to see affected really with uncertainty and things changing up when it comes to lending and people going ahead and having extra cash and even cash that they're willing to spend would be tourism. Yeah. So I think kind of getting into that before we kind of get into all the other nitty-gritty with us being Orlando.
Yeah, that's the big one.
Yeah, I feel like we are going to see a shake-up to our tourism. How dramatic it might be, that's yet to see.
Yeah.
But at the end of the day, I mean, I do know a lot of our commercial sector is dependent on that. So
tourism is a really big part of the Florida economy in general. So Florida in particular is probably going to be highly impacted. I would imagine that, and this is something for us, like my wife and I and our kids were thinking about doing some international traveling this year. And we've essentially taken that off the table.
Yeah, funny enough, my girlfriend's family is they're still moving forward with their international traveling, but they're in contact with the U.S. Embassy.
Correct.
They got all their emergency plans
in
place.
So if something happens,
because their thing is you can't be in another country and not know what to do.
Yes.
So yeah.
So it's just it definitely presents a challenge because you don't know what can happen. I mean, you don't know to what extent or how bad it's going to get. Hopefully it doesn't get any worse, but we just don't know what's going to happen. So I would imagine a lot of international travel is going to slow down because people are going to be nervous about what's happening globally.
Yeah.
Like if there's a war between two major forces in the world. And not to say that Iran is necessarily a force that's big enough to face up to the United States, but we're kind of going over there. So we don't know what they're willing to do or not do. We looks like we've seen, they're attacking whatever they have access to attack, and I think that's what they're going to do. They're probably going to focus in on United States allies, which is places where we would probably tour ourselves. And I would imagine people that are from those countries would probably be rethinking whether or not they want to travel to the United States, because the United States is probably going to be, potentially targeted if we're in a battle with another nation. So, there's definitely going to be, I think, a lot of anxiety there. I would even argue that national travel is probably going to be limited too. I think people are going to be nervous to get on planes, to get on trains, to get on any kind of public, transportation method that is not their car.
Yeah, agreed.
So you might see more regional traveling. So I'm sure people will still travel from Georgia to Florida, right, in a car.
Yeah.
But they may be less likely to travel, in a more commercial vehicles.
Yeah. And I feel like the second part to that is just like uncertainty in general. In uncertain times, people tend to hold on to what they have.
Yeah,
so
yeah.
That would be another part.
Yeah. Uncertainty actually really causes people to do nothing.
Yeah, exactly.
Like they just I'm gonna hold off. I'm gonna just wait and see.
I'm not gonna take this vacation.
Yeah.
I'm not gonna go get this other job.
Yeah, absolutely.
I'm just gonna hold tight.
So I think that's going to have a huge impact in, I think, the economy of Florida in particular. I'm sure obviously it'll have an impact across the United States, but in particular, Florida has a very strong tourist base that it's typically highly reliant on for a big percentage of its economy. So I would agree with you. I think tourism is going to be highly impacted from that. Now, as it relates to the other thing, you talked about uncertainty. And one thing that uncertainty also does is that uncertainty tends to also cause financial institutions to be a little bit more conservative. It causes, if there's any fluctuation in the economy, then typically the Fed will make adjustments with rates to, let's say, to stifle inflation, for example. Yeah. So those things will have potentially an impact in mortgage rates for lending and whatnot. So I think from a financing perspective, I think that there's a very good chance that we're going to see just sort of unpredictability in interest rates. I don't know that it's going to go up. I don't know that it's going to go down. I know right now the Fed has been talking about continuing to lower the interest rates. Yeah. Which doesn't necessarily have a direct correlation, but they're very related to mortgage rates and how much lenders actually charge. So there's definitely they're wanting to push that way. But when you have a war on the other side of the table, that becomes very unpredictable.
Yeah, for both sides.
Yeah.
And even, I also feel like, at least with some of the buyers that I've been working with, that even their requirements have tightened up a little bit as well. Yeah. And even when I ran the numbers this morning, in regards to mortgage rates specifically, just this morning I ran them at 6.46. So after just 2 weeks ago, we were borderline right on 6%.
Yeah.
So.
Yeah, so whenever there's any kind of disruption in sort of like global disruption, and that's what this would be. It's basically a global disruption. Banks are going to get more conservative. They're going to get nervous, and they tend to just whenever they get nervous, the anxiety kicks in. They become more conservative, which means that interest rates are going to be going up. That means that they're going to be tighter with their lending specifications. They're going to be more, they're going to be really picky about what kinds of projects they loan on and, to who they loan that money to.
And if they see a red flag, they'll be more willing to say, we're sorry, we can't move forward.
Correct.
Than saying, hey, let's find a way around.
Correct. So I definitely think, both capital and interest rates are going to be a challenge over the next few months.
Yeah.
Excuse me, I'm getting over a cold.
Oh no.
Still have a little bit of a cough that kind of lingers. But I do think that access to capital is going to be, I think will be a little bit of a challenge over the next few months. So specifically capital from institutions will be a little bit of a challenge. So we'll see how that plays out. That is, I'm not I don't like predicting, but I think that, without getting into, the tea leaves.
Yeah.
I think it's a pretty good bet that rates are likely to be unpredictable, where we had sort of an idea of where they were going, but I think this is going to change a lot of that. And I think there's a really good chance that just capital in general from institutions is going to be much more difficult to access. So, so if you are looking to get a loan, make sure you have all your ducks in a row. Make sure you have, all your financials in place. You get an assessment from your lender as to what it is they're looking for, because they're probably going to be more strict with who they lend money out to and on what projects they're going to lend on. So their risk tolerance is probably going to go down.
Yeah.
So I do think that that's going to be something that is should be expected. So now, talking about tourism, the sector that's going to likely be hit the biggest here is going to be hospitality.
100%.
So this is going to be, I think, a big problem for the hospitality industry. They've already been hit with the economy. The way the economy is performing right now, it's already been been difficult for them. The urban centers, which is going to be more of like your city centers, and conference centers, so hospitality projects that are built to be in support of conference centers, like the Orlando Conference Center.
Yeah.
Like those are going to be the most impacted, primarily because if people aren't traveling to go to a conference, because that was already a thing. People were already starting to travel less for conferences and stuff. There were less conferences happening, more virtual stuff happening. So, or options for virtual access or whatever to conferences. So you were having less people traveling in general already. And then now you have this additional layer of concern for traveling during wartime. I think that those locations are probably going to get hit with some serious difficulty.
100%. 100%. And that kind of falls right into the research that I was seeing as well, because I was seeing conferences and convention centers, due to your point, would be one of the ones for hospitality that would be weakened the most.
Yeah.
Well, and this one kind of surprised me, at least from the research I was looking into, and from 2024 to 2025 and even beyond, that it looks like, actually, even with this uncertainty, that the resort style places that are more like leisure focused, and some of the more grandiose ones, the bigger names, those ones won't be affected as much, or haven't been affected as much.
Well, it's interesting because I think a big part of that, at least historically over the last, I would say since COVID, with the ones that are built next to conference centers. Now, I'm sure the leisure ones are getting impacted.
100,
but
they are, just not as dramatic.
Yeah, and I think the dramatic change between what's next to a conference center versus what's leisure is that, we have international, national, and local travelers that come in to leverage leisure time, right, in these vacation rentals and stuff like that. And they come for their families. They're not going there for executive purposes, right?
Yeah.
So when you have COVID, they came in and kind of changed the landscape on how people do conferences. So it came from personal, in person, to fully virtual, to then like maybe a hybrid. Well, even by going back to we don't have to worry about COVID anymore, people I think got accustomed to a hybrid. Well, if I'm a corporation and I have a big conference that I pay for all my people to go to, I could either pay for all of them to go, or I might pay one or two top level people to go, and then say to the rest of them, you guys can join virtually. And the cost is significantly lower because I don't have to pay for all of them to go because there's a virtual option. So now you translate that on the flip side to what that means to the hospitality side, right? Is now instead of 12 or 20 people coming from one company, you got two or three. So that's okay. Well, now you're short 18 rooms, right? To provide for these people. So now how do you fill that?
Yeah.
And if it's for a conference, well, if the whole conference is less people, there's nothing you can do about that. Mm-hmm. So I think the conference centers in particular have been hit heavily since COVID, and it's gotten slightly better, but it just really hasn't recovered fully. So I think that this is just going to make it worse for them. Like any recovery that they have received is probably going to be just completely negated now, right? It's going to make it even worse because now people are like, I don't want to travel on a plane.
Yeah.
You know what I mean?
Yeah.
So not right now, at least, right? So I think that you're going to see that. I do think that there is probably going to be still an impact to leisure, not as much, but I still think there's going to be an impact to leisure. But people can still, like, people may decide, oh, well, I don't want to take a plane from South Carolina, but you know what? I'll drive, right? We'll take a day and we'll drive,
Yeah.
you know, because that's a day's drive, right? So you can still get the region to come to Florida, and that could all be within a day's drive. So I still think we'll see some of that. It'll probably be less, but we'll still. But I think that's the reason why you're seeing that. You know, the leisure is, you know, anyone who just wants to take time off, where the conference hotels are typically for people coming to conferences. That's why they built them. They built them because they felt that they were going to have conferences all the time. Of course, you'd want to have a hotel next to a conference center. It's ideal.
Yeah.
But
mean, for the worker and for the owners.
For everybody,
Yeah.
right? It's ideal. It's ideal for everybody.
Yeah.
So I mean, I the conferences that I've gone to where there's a hotel next door and right next door. I mean, I get out of my room and I walk into the conference. I don't got to drive anywhere. I got to worry about parking
Or
it's
Uber
awesome.
or any of that.
Yeah. So if people are doing less of that, then that's why those centers are getting hit so hard. So I do think that they're probably going to really get slapped in the face. It's going to be interesting to see what the hospitality world looks like a year from now, because a lot of those, they were already struggling. Their margins are probably not amazing as it is right now. So if they get hit even harder, or they get hit back again from, let's say, this happening, then there's a good chance we're going to see some trading in the hospitality realm.
Yeah, and even I've even seen some restructuring. So these hotels are even in some cases, not very often, but the convention centers going ahead and pretty much repurposing themselves.
Oh, to like multifamily
exactly,
or something?
Yes,
Oh,
sir.
yeah.
So going from being a hotel to maybe a multifamily high density living situation. And a lot of people have been doing that and finding a way to kind of fix their situation through that.
Yeah, so I mean, what's cool about that is that's what we call in the industry adaptive use, right? The hotel already has all the infrastructure, has all the plumbing, it has all the power, and all the rooms. I mean, you might have to maybe merge some rooms to make them a little bit more apartment-like.
Some more build out.
But add some full kitchens and stuff like that. But generally speaking, most of the infrastructure is there, and they already are permitted for the density.
Yeah.
So oftentimes they can do that, and multifamily, once you have it up, especially if you get a good purchase, you can usually exit pretty well once it's stabilized. So that can be a good play. We saw a lot of that during COVID when everything kind of went sideways, and those hotels that were kind of on the margins of like not really performing well, and then the COVID just kind of like.
Yeah. I remember during COVID there was malls that were doing that. Yeah, because they were just, unfortunately, retail was down in the toilet, so they pretty much repurposed the entire malls into high density living.
So it's interesting to see how we adapt. That's one of the things that I love about commercial in general, is that there is options to adapt. The challenge becomes oftentimes it's usually there's someone, it's at the detriment of someone or a group or something.
Unfortunately.
Yeah. So but it's better than it just being an abandoned space, right? So but I would say hospitality right now is definitely at high risk. If you're in the hospitality space, you're going to definitely be watching those numbers and figuring out like what's your exit strategy if things really go sideways.
Yeah.
So
and then speaking of risk, aside from hospitality, and before this has actually been a great investment, but actually data centers have been also, at least from what they're saying on the news with everything going on, being potential targets.
Yeah, so that's a really interesting one, because data centers up until this whole scenario was the opportunity to take advantage of.
Yeah,
like it was the thing. AI is
power,
growing. Computing power is required. There's all kinds of there's all kinds of there's a huge need for more data centers in the United States, and it is probably one of the strategic advantages that the United States still holds on to in terms of its capacity. Is there's a lot of capacity here, a lot more potential capacity for being able to have more computing power. I think that is probably one of the areas where the United States can still dominate. And I think it would be great for us to be able to continue to do that. But it also means that it becomes a target whenever you get into a scenario like this.
Yeah.
And if if Iran wanted to really do some damage, data centers would be the place to go. And they have risen their hand and said that's what they're going to do. So because data centers are now becoming a target, that is something that increases the liability of investing in data centers. Like, do you want to invest in that? I guess you could buy terrorism insurance. I mean, that's a thing.
And it doesn't have to be anything physical. It could be completely electronic now.
Yeah, it doesn't have to be it doesn't have to be a bomb.
Attack your data center through the internet.
Yeah, exactly. It could totally be something that has nothing to do with explosives at all.
Yeah.
So, so it's interesting. Literally a month ago, data centers was the creamiest opportunity that you could get into, and now it's still an opportunity, but with this huge cloud hanging over it of liability. It's like, okay, well, what do you do when the asset class that you think has an opportunity, has a huge opportunity, huge upside opportunity, also has this sort of it's being highly targeted as a potential focus for retaliation from an adversary, and that's always kind of been the case in general. But when you get into war, the stakes move up substantially. So I think that data centers are one of those things where there's still a lot of upside opportunity. I don't think we should necessarily stop the pursuit of expanding our data center footprint.
And in all reality, we really can't as well.
Correct. I do think that I would agree with that. I would say that any data center that anyone's going, if you're going to get into the data center world, I would definitely say that one of the top priorities is going to be security, and not. When I say top priorities, it was already a top priority. Now you got to escalate
even further.
Yeah, you got to escalate that priority to ensure that there's obviously for physical, for cybersecurity, for all kinds of things, but you're going to really have to increase your opportunity. I would argue that you also may want to seriously consider some kind of a terrorism insurance for something like that, because it's very plausible that could be a focus. So, while I still feel very bullish about data centers, I think that if you're going to get into data centers, you're definitely going to want to focus very heavily on security, because they've already identified that that's going to be one of the key areas for retaliation. Mm-hmm. So that's a concern. That's obviously a concern. I mean, if you're putting your money into something, it's a concern that thing can completely be obliterated, both either physically or just through like hacking.
Yeah.
You know what I'm saying? They can just empty out. You could hack it and completely delete everything.
Yeah, no, and that's crazy. I mean, to me, and it's so funny because all my friends who are going ahead and getting into the workforce, a lot of them are in the tech industry. Yeah. Orlando is actually one of the #1 places for
it's growing. Workers. Yeah, absolutely.
Yeah, and all of them are cybersecurity or going ahead and just doing some type of software maintenance mm-hmm. or whatever. And it's just the amount of them. And I always ask them how's the job market for you guys? And they're I have all these opportunities.
Oh my goodness! There is not enough people to fill the need.
Yeah. I mean, even one of my guys is doing 6 different jobs because he doesn't have enough help where he works.
Yeah.
So
no, I hear you. I mean, yeah. I think cybersecurity. My daughter is actually going into the cybersecurity world. She just got out of the Air Force and she's being trained in cybersecurity. And she saw the tea leaves. I mean, she kind of looked at what opportunities there are for jobs. And she saw that the highest opportunity there is for jobs right now is in cybersecurity. She looked at the pay. She's like, that's no question.
Yeah, done deal.
Yeah, done deal. She just looked at it.
And we need her.
Yeah. So you know, it's definitely going to be a very serious need. You know, to whether and AI can probably play a role in that too, and I don't know to what degree, but you know, I like data centers as an asset class personally, but I totally see the risk that is also underlying data centers in our current environment. And you know, if you're going to get into data centers, you definitely want to make sure that they're really thinking about all the potential risks, not only from what is typical for a data center, but what is atypical. You know, or what may be typical in this case for under wartime scenarios.
Mm-hmm.
So yeah, I it's unfortunate that that's the case, but you know, it is what it is. We just want to make sure that if you're thinking about a data center, you want to make sure you're thinking about those kinds of things.
Mm-hmm.
So, all right, now, you know, one of the other things that is I think it's called the Hormuz. I think it was what it's called.
Oh, the Strait of Hormuz.
Strait of Hormuz, yeah. So that doesn't have a huge impact for us for oil per se, because we don't get a large percentage of our oil from through that strait. But a lot of the countries that are in that region that we do business with do use that, right? That's a big pathway for commerce and trade as well as for energy, which means that because we import a lot of materials, the building materials, just a lot of materials in general, we import just about everything. We don't really create a lot of the materials that we use for construction here. So that means that development also is at a higher risk right now. Development has already, you know, been impacted negatively by just general cost of goods. You know, that has increased, you know, risk for development. Most of even developers right now, for example, don't even want to spend the money on because they're concerned with the costs that may happen. They don't even want to buy property that isn't already that doesn't already have what do you call that? No, I can't think of the word. That hasn't already been established. Entitled. Thank you.
I was thinking that was it for a second, but I didn't want to throw you off.
I think I still got brain fog from my cold. My brain's not working right.
Hey, I got you.
Yeah. So what we're hearing from a lot of the developers is that they really want to have something that's already kind of entitled, so they don't have to wait a year to start building. Because the problem with waiting a year is that the materials that their pro formas that they're building is based on today's pricing.
And we can't do a year's pricing from now.
Yeah, they don't know. They don't know what it's going to cost. But if they can start building today, they can do a pro forma based on today.
Yeah.
So a lot of the property that they're building, that they're wanting to purchase, is already entitled, so they can start building right away.
Yeah.
Because they know what it costs today.
Yeah, and they can lock in that $250, $300 a square foot instead of being, we might be at $325, $375.
And a lot of times they buy a lot of the material in bulk, so they can buy it ahead of time, you know, and they know what the cost is.
Exactly.
So you know, when you would go through the entitlement process, that could take a year to get, you know, to get that finalized. And with, you know, with the way that materials are changing in their pricing, you know, you might do a pro forma based on pricing today. Even if you had a 10% increase, it may be more than 10% in a year. Who knows? So I think that you know, development is being stress tested right now, the cost of development. So you know, I think that there is likely to be some more potential cost increases to imports due to the Strait of Hormuz being blockaded by Iran. If that lasts a long time, then the cost to ship things is just going to be more expensive. Yeah. And that could also mean that that could be a combination of the actual cost, because it takes longer, you got to go a different route, or the cost of fuel for them. They have to get from another source, which is more expensive. So, you know, it could be either of those two things, or it could be both of those things. Could just cost shipping materials here make it more expensive.
Yeah.
So that could have a detrimental effect to the cost of development. And so I think that development projects are right now are potentially at risk because it's going to make the cost of materials potentially more expensive. Now, of course, I don't know that for sure, but if you're cutting the access to fuel to a country that you buy materials from, then that they're going to have to get fuel from somewhere else, which is probably going to be more expensive. That's going to make it more expensive for them to bring material here.
Exactly.
If you're cutting, maybe they get fuel for the same price, but you're cutting the pathway for them to travel to get to us
longer,
then they have to take longer for them, then that's going to cost. And so you have two different elements that could potentially impact the cost of goods getting here. And not to say that that's how it's going to happen with everyone, but I definitely think that's going to have an impact. Yeah. So there's a good chance that the cost of development could increase. So I do have a worry about that. I don't know that that's for sure going to be the case, but there's a good chance that that's going to be the case. So just be paying. I would be paying very close attention to that. If I were a developer, I would definitely be looking at entitled projects that are ready to build, where I know I can buy the materials today at today's prices and get those done and get into them quickly before there's any impact in the cost. Otherwise, I probably wouldn't be buying land that's not entitled.
Yeah, and I mean, even on the other side from acquisitions, even if you already own your asset right now, it's probably a good thing not to over leverage yourself and just make sure that you are kind of keeping funds available to yourself.
Oh, for sure.
Whether you need to do a repositioning or something comes down the road that you need it ready for, just to have it available. So
yeah, I mean I think that's a good strategy to have in general.
Yeah,
I think it's exacerbated during times like this where there's a lot more uncertainty.
Well, there's a lot of people that want to make improvements and see, and I would say, at least from what I'm seeing on the market, there's quite a few opportunities with value adds to where people might go in and accept themselves or allow themselves to put in a lot of leverage right up front to make those improvements. Yeah. But right now, I mean, it might be something you want to consider both ways,
Yeah, I mean, I think that, when, if you're going to do something like that, I would say that there's an advantage to someone who has cash reserves
100%.
Versus someone who's using leverage because of the fact that we don't know where interest rates are going to be at. Money's already a little bit more expensive than we've seen in the past, though it's not terrible. But the problem is that it's unpredictable right now. So I mean, if you get something now in the sixes, you might be okay.
Yeah.
But if it happens to go up, then that could be problematic. So so definitely pay attention to what your options are. I would definitely say you're probably going to want to focus on cash reserves as opposed to using leverage if you can, so that you don't have an additional cost, assuming that you have it. Unless it makes so much sense for you to use leverage to go ahead and take advantage of that. I mean, I'm not saying not to use leverage. You just want to make sure that there's a really good upside to doing that.
Yeah, okay, I do this, I follow these steps, and I'll get my return 100%. It, please.
Yeah.
But the risky stuff,
Yeah, just make sure you're paying attention to those things. So, I mean, other than that, I think the other risk factors that you just got to be paying attention to is that, again, just reemphasizing that this kind of situation just exacerbates the already existing challenges, which we've kind of mentioned before, which are interest rates. We knew that it's been stabilized for the most part, and we've been seeing a little bit of it going down over the last few months, and not very much, but just slightly. But this is definitely likely to kind of make you may see a hiccup, and that hiccup could be a little longer lasting than we prefer. As it relates to interest rates. I think insurance volatility is going to continue because if there is a concern for example, terrorist threats, I would not be surprised if insurance companies start requiring terrorism insurance for certain asset classes, specifically hospitality, data centers, right? Those kinds of things where they may be at threat. Even entertainment centers where there's people congregating, right? So
just in general, I didn't even think about that.
Yeah, because you could do a lot of damage
unfortunately,
something like that. So I would not be surprised if insurance even decides, makes the decision to increase their rates because of a concern for terrorism threats. So, but we don't know how that's going to operate. But those are things that are definitely going to have an impact. And the only other thing is, basically what we mentioned before is just, if you have a highly leveraged asset, you might want to just make sure your numbers are looking good.
Yeah.
If they're not looking good, or if they're like tight, you might want to trade. It may be a good time to trade, because if there's a dip at all in your returns, and that could be detrimental to you. You don't want to be in a distress situation trying to get rid of that asset, because and then on top of that, people are already nervous to buy an asset during this time and stuff like that. So like if your asset is performing half decently, but you're like right there with your how much leverage you have versus how much return you're getting, you might want to go ahead and seriously consider, unless you have a plan to increase your returns, you might want to seriously consider going ahead and trading out, because to try to get into something that doesn't have as much leverage, and that way you have at least a buffer in the event that there's any kind of downward momentum on the asset class that you have. So that's the bummer. This is all the negative stuff.
Yeah.
We wanted to get through that first. Was there anything else you want to talk about as it relates to negative stuff?
One more thing specifically to commercial, because we did go ahead and we talked about data centers, and then we talked also about hospitality. I feel like the only other thing I wanted to mention, which we actually were talking about this prior to the podcast, is also offices. I mean, it's already been struggling since COVID,
sure.
But even now it's actually having some more issues as well. And I just want to reiterate this was Gus's point prior to, but the amount of people that are choosing to go ahead and attend these meetings, or like the conferences, or even go ahead and show up to work virtually rather than in person, is really increasing. And that's actually making it to where less office users are coming out of the woodwork and getting some. Actually, office in general is the most vacant asset type right now.
Yeah, office is definitely struggling. I would completely agree with you on that.
Yeah, so that's the last bad news I just want to put out
there.
Yeah.
And I'll say this, office has been struggling without the war.
Exactly,
right?
Since COVID.
Yeah, it's been struggling since COVID. It did a little bit of a bounce back when people started getting into the hybrid system. So we've been seeing a lot of corporations kind of doing sort of a hybrid, where they brought some people back and then maybe allowed them to work from home periodically, which allowed them to maybe downsize the size of their office, because people could share office spaces and stuff like that. So we did see some of that happening, but there's still a lot of people who definitely work remotely. I mean, I have a lot of friends right now that they work completely remote. My daughter works remote. My son-in-law works remote. One of our friends, one of my wife's best friends, she works completely remote. She was working hybrid, and she just got a new job, which is completely remote.
Yeah.
So that's definitely a thing. And the question then becomes, okay, well, what is to happen with that asset class? In my view, I think there's an adaptive opportunity that can happen there. So, but I think the war situation is definitely going to back to exacerbating existing risks. It's going to just continue to exacerbate that risk.
Yeah, and it's going to make the people that have an office that might need a value add, or needs improvements in general, to where they're going to have to really consider making some improvements, because the ones that are actually kicking butt in the office sector are the offices that are located in high amenity areas, updated pretty much facades and all of that. And a lot of times you don't really think, obviously people want the newest thing on the block. But a lot of times you don't really think just because they made it pretty, that's going to help add value. But the workers actually really appreciate it.
Yeah, so
drives it.
What's interesting about that is that that to me signals a higher interest in culture. Like the culture of the office space. So the ones that are actually performing better in the professional office space is the ones that have amenities built into the office, where the office is built to be a place where you can go to work, but there's also some things that you can do that's not work related, that'll help you with your health, that'll help you with your just clearing your mind, whatever the case may be. Like they have things that would help you that have nothing to do with work.
Yeah.
Right? And that's a culture thing. So like if you have a gym at your office, The office doesn't have to provide you a gym.
No, but that would be awesome.
That was, yeah.
I wish our brokerage had a gym.
Yeah, so like if you had a gym at the office, then that's a culture thing.
Yeah.
Where the office is trying to create a culture of like, hey, we really want you to be healthy.
Yeah.
Right. If there's a place where they do like a yoga or whatever, Pilates or classes like that, that has nothing to do with necessarily the work directly, but the office is trying to offer like a element of culture in the office, right?
Mm-hmm.
So I do think like that sort of whole wellness element that these typically that you'll see for some of these, and sometimes they'll even do like maybe there's food or something like that, or that's not necessarily wellness per se, but it is still sort of, I would say, arguably like office culture element.
But nonetheless, an amenity.
Yeah, so those things I think are what are performing better because people are more willing to go to those offices, right? It's easier to go to an office where you feel like, oh, I'm welcome, they want me, they want to take care of me.
Yeah, and it's not 100% work. There's other.
Yeah, exactly. Yeah. So I totally see that. The other, if you're going to do those kind of improvements, obviously there's a cost to that. And you got to see, are you going to get the return? Are you positioned well to be even able to do that kind of office space? The other option that you have is if you're not going to stay, if you're not going to stay in professional office, you can also look to see if the property could work as medical office. You'd have to see if it qualifies from a zoning perspective, and then you can do a complete adaptation and just change the use completely. We've seen offices converted into multifamily.
Yeah,
we've seen that before. So and again, those are all costs. So is that something that you even want to do? It all depends on the position you have on the property.
And what works best for you in your position.
Correct. So, but that's a good point. Office has been struggling quite a lot, and this whole scenario is probably just going to continue to exacerbate that.
Yeah.
So now that we've given you all the doom and gloom and how the world's going to end, we'd like to share with you some opportunities.
Heck yeah.
Yeah, so, all right, so some good stuff, right? So I think that the opportunities here, is if you're not dealing with a bank, so I think that there's some opportunity there, right? So you don't have to worry about what's going on with interest rates or anything like that, or how tight capital is for you if you're not dealing with an institution. Now, if you have cash, either that's your personal cash or private money or however you've raised cash, then you don't have to worry so much about that, right? The good thing is also if you're in that cash position, you don't have to worry about going through the approval process. One, two, it also helps the seller understand that, oh, I don't have to worry that you may not make it through the approval process.
Yeah.
And then because there's a lot of anxiety in the market, you're probably also going to see less competition if you're a buyer, right? So that also means that you may have more negotiating leverage in an acquisition because there's less anxiety as it relates to. There's less competition because there's more anxiety in the buyer market because they're worried about what's going to happen.
Yeah.
So if that doesn't necessarily impact you and you feel like the numbers still work for you and you don't necessarily have that sort of anxiety about making an acquisition during this time, then being a cash buyer could be very advantageous. I would say that there are some specific asset classes that are probably still going to perform well. One of the asset classes, my favorite asset class by far, is the most consistent asset class that I've seen, and that's industrial, specifically as it relates to logistics. I mean, that asset class continues to improve, and I think a lot of that has to do, honestly, with the fact that the logistics for the United States. So one of the things that was really interesting to me was that it didn't dawn on me, like, strictly from like the things that we're good at from as a country is one of the main things we're good at as a military. We're a military force, but one of the things that that makes us such a powerful force in the world is our Navy. We, from a maritime perspective, we dominate. Yeah, we dominate the water, right? By far, we dominate the water, and I think it's probably one of the critical things that differentiates our country from all other nations is our ability to dominate the water. And if you look at all of our logistics, it's all water-based. And that makes sense because we're surrounded by water.
Yeah.
We're East Coast, West Coast, the Gulf of Mexico, like literally, even the north side, we have the Great Lakes.
Yeah.
So I mean, we're almost an island.
Yeah,
You know?
just about.
Yeah, you know what I mean? Like there's water on all four sides of our country, and there are major waterways. It's not like just a river here. Like there are major waterways, and then we have major rivers that go through the country.
Mm-hmm.
So you know, from a logistics perspective, all of our logistics have been highly focused on waterways, and where we've had to kind of make improvements has been in sort of ground transportation. So we've not, you know, that's in trains and trucks primarily. So that's roads. So the more that we can build out our logistics from like ground transportation, I think the better we can perform, the more efficient we'll be as a country. So this is something that I think, you know, we've been lacking for a long time, primarily because I think we've been just a dominant force in the world. You know, our dollar has just been so strong compared to other currencies and all that good stuff. And I think that now that we're starting to see a little bit of a weakening in the dollar. There's some challenges on the horizon with other potential competition with trade, with energy across the world, not necessarily using the dollar, but using other currencies. Yeah. It's starting to make us have to rethink the way that we manage logistics here at home. And that is causing us to really look at different ways to put in logistical elements into our country. And Florida was a perfect example during COVID. Like Florida, for example, did not have a huge logistical, I would say logistical, I'm gonna say railway, but I mean railway by just any kind of logistical pathways. There was some, but it wasn't until COVID, specifically till we opened up our ports to when California was having all these challenges and backups, that we opened up our ports and say, hey, bring them here, we'll figure it out, right? And during that time, that's when we realized like, oh, we actually can do a lot more logistics than we thought. Yeah. And we saw a huge influx of distribution centers, refrigeration, warehousing, just a lot more roads that started getting built.
Yeah, and then the state of Florida backing it all up, because I even remember 2-3 years ago they built the East-West Railway to help the folks that are coming in, especially for Port Canaveral. So.
Yeah, so you have these elements that has been lacking in the United States, and now it's an opportunity for us to catch up, which is great because that's an opportunity, right? If you are an investor and you're looking for an opportunity to invest in, in commercial, I would argue that logistics is still a solid go-to. So there was a huge peak in activity during COVID, and then we saw a little bit of a downturn. But what's interesting is that downturn just kind of put us back into normal. Like it wasn't like a downturn and now it's negative. It's like, oh, it just went up and then it kind of just went back into normal. Yeah. So now we're kind of in a nice solid growth mode for logistics. So, I think warehousing is still a strong asset class. I would say that, probably mid-size to smaller warehousing, industrial properties are still probably the highest in demand, with some of the larger ones maybe slightly less in demand. Yeah. Is kind of where I would put my money if I were looking at looking for growth opportunities.
Yeah, and I would have to agree. I mean, a lot, even if they're not startup companies, a lot of them are only looking for anywhere between 4,000 and 10,000 square feet. Yeah, yeah. Which is actually a smaller size.
It's considered to be small footprint.
Yeah. So,
yeah. No, so the other sector that, at least for Central Florida, this is going to be Central Florida specific, the biotech and healthcare industries, like those specific, anything related to biotech and healthcare in particular, like those categories are going to be really strong. Primarily, those are typically like and I'm talking healthcare, like research. And I think one of the main reasons for that is because we have such a huge 55 plus community. So there's a lot of research around like, cancer research and, longevity research and, just healthcare in general, kind of medicines, pharmaceuticals, all that good stuff.
100%.
So I think there's a huge play there. We're seeing a lot of growth in that sector. And I think Central Florida, if you're looking for an opportunity to get into something that's going to be more in the tech world, but you're not necessarily sold on, let's say, AI, I think biotech would be the other option that you can definitely get into, and there's a good solid growth opportunities that are in Central Florida for that. So I would argue that going into like the biotech health innovation space is where you want to be thinking about, right? Now those are sort of like, I think, growth opportunities where we're seeing a lot of growth. Now, there are some stable asset classes that I think are solid investments that if you are not necessarily looking for, because obviously when you go into any of these newer options, there's going to be risk involved. Growing the logistics, there's definitely a growth opportunity, but hey, I mean, it could get shut down like anything else, right?
Pretty much.
Same thing with biotech. Biotech looks like it's growing, but who knows, right? But some really stabilized asset classes that I think have a really strong opportunity. I would say conservative opportunity.
Yes.
A nice conservative opportunity is going to be multifamily.
Which it has been for a long time.
Yeah, so multifamily is going to be strong. I would argue that multifamily outside of city centers.
Okay, yeah.
So you want to be outside of city centers. Multifamily outside of city centers, that's where you want to be. You want to be in secondary and tertiary markets.
Yeah.
Those markets are growing, especially specifically in Central Florida. Those markets don't have enough housing, so multifamily has a really solid, can be a really solid footprint. I would say that you don't have to develop multifamily. You could probably buy something and do value add and be great.
Yeah.
Be in a great position. Because I think there's some really good multifamily opportunities in Central Florida, specifically in secondary and tertiary markets. I would probably avoid like city centers. So not Orlando, not Tampa, not the centers.
Yeah.
I would go outside and be into like the Claremonts, Winter Gardens, Sanfords.
Yeah.
Go out to
the Brandons. And all
yeah,
that
exactly.
Yeah.
So you want to be outside of the city center. I mean, I think that's where you're going to see the most return for your capital investment, and those are going to be solid because the growth for those areas have been faster and higher than the growth in city centers. So I think that's where the opportunity is for multifamily. Neighborhood retail, this kind of goes back into what we're talking about. Neighborhood retail is commonly, that is the common reference for like suburban town like retail. So this is going to be like, in smaller secondary and tertiary markets is where you typically see neighborhood retail. So those are pretty solid. People are still shopping locally, even though they may not travel to, like, before it was the case where you might go to Orlando and go to the fancy shopping areas.
Yeah.
Now we're seeing a lot more people shopping more locally. So, the neighborhood retail centers are still performing pretty solidly. And this, for example, our immediate market, there's hardly any inventory.
Yeah.
It's like almost non-existent.
Yeah.
It's so hard to find a tenant space. It's so hard to find a buyer space to buy. Like, it is almost impossible, right? So like,
and really the most opportunities we have here are full development ones.
Yeah, brand new.
The most expensive.
Yeah, with the most expensive ones, right?
Yeah.
So otherwise it's a really, really tight market, and we're seeing that across a lot of secondary and tertiary markets where it's super tight, but then you go into the cities and the city centers and there's a lot of vacancies. So like, I think that it's kind of flipped, where before the city centers were the place where there would be no vacancies and demand was really high. In secondary and tertiary markets, there wasn't a lot of demand and vacancies were a little higher. But now it's flipped. So now we're seeing city centers are tending to have higher vacancies, at least in Central Florida, higher vacancies, and then the secondary and tertiary markets are a lot tighter markets. They're harder to find retail spaces. So for both for tenants and for buyers. So I would say that that's going to be a good buy if you're in a secondary or tertiary market. The other one I would say is anything related to healthcare. So if you buy, a medical office, that's going to be a good buy. Medical is doing well. Healthcare industry is growing, in our market. I think that, without a doubt, has to do with just where retirement state.
Yeah, I mean, it's still, and I mentioned a week, but as Florida, Orlando as a whole, I think we're going ahead and growing like 150,000 people a year.
I think that's Florida.
That's Florida?
I believe that's all of Florida.
I think I was right the first time.
Yeah. I think that's all of Florida. But that's still a lot of people.
Yeah.
Right? That's still a lot of people coming, and a lot of them are coming to Central Florida. So, the retirement community alone is, a reason why we're seeing the healthcare industry grow. So, and medical is, definitely in high demand. So if you are looking to purchase, that's one of the office categories that actually is doing well, is medical office. So which is kind of its own thing. I mean, it's its own animal. It's a specific
user.
It's definitely an office, but it's definitely its own animal. So, but I would say any kind of medical or healthcare related, healthcare adjacent, senior, support type of space, you're probably going to be okay, because there's a huge demand for services for that community, and that community is huge and it's continuing to grow. Excuse me. So, and then the only other thing is it's kind of been the ongoing staple for decades, is just self-storage. I mean, people store stuff.
People always have extra stuff.
They got stuff, and they don't throw stuff away. And self-storage is it's kind of a high margin investment. So if you can find it, it's usually a pretty good investment. The biggest challenge with self-storage is most of the people who are selling self-storage is because it's so old. Like, the only option is for them to tear it down and build something new, and they just don't have the money to do that. So most of the time, if you're going to get into self-storage, it's probably because you either found someone who just happened to be in distress and they have to get rid of it, which is rare, but that could be the case, or it's a new project that you're buying into. Otherwise, most of the self-storage that we typically see on the market is old. People had it for 30 years and now it's
run its course.
It's run its course. It's not, you don't want to keep it, right? You want to get rid of the building and start over. So, but self-storage is people call that one of those like cash cow type businesses. It definitely has good margins, and it's a safe bet. You could probably get away with, especially if you're getting something that's not terribly old. You're going to be okay with self-storage. So, I mean, I think those are where the opportunities are. Those are where some of the conservative options are. So if you're trying to figure out where to put your money, I would say those are going to be the areas that you're going to want to focus in on. So just be wary of the negative. It's not all doom and gloom. There are definitely opportunities out there. We just want to make sure that people are aware that there are some things you want to consider. You want to be thinking about. So, do you have any other thoughts?
No, I think we pretty much hit everything. So,
okay, great. So if you guys have any thoughts about anything that we've mentioned here, or if you have counter thoughts to anything we've mentioned, we'd love to hear about them. Make sure you comment below. We'd love to hear about what you have to say about it. If you have any questions about anything we've mentioned today, or just anything in commercial or related, feel free to leave a comment or just reach out to us directly. We appreciate you. Thank you guys so much for watching. Please please share. My name is Gus,
and I'm Brad,
and this is the Commercial Department podcast. We appreciate you. Thank you so much. We'll see you guys next time. Peace.